How do you not lose money? How do you preserve and protect? How do you get ready for the doomsday preparation? Buy low, sell high, and don't lose money. Successful people create. You are here to create your financial future. It is way simpler than your advisor makes it out to be. It is way simpler than other financial gurus and analysts. Preserve and protect the money that you have, which means sell high and get into something that protects your assets. Welcome back, everybody, to another wealth webinar. Thanks for joining Stephen and I. And today we're going to talk about some really important issues. We got a whole bunch of stuff to cover. It's going to seem like I'm all over the place, but I'm going to bring it back at the end to the conclusion. But I want to call this the doomsday preparation. That's what I'm going to call this wealth webinar. I know that sounds super bad, but if you were on wealth webinar, well, things are a little wonky out there. I mean, you got Iran launching missiles at Israel, our ally. You got Israel promising swift and harsh response to those missiles being launched. You got an election, a very controversial election. Although last night's VP debate was pretty awesome, to say the least. I thought that was probably the best debate I've seen in my entire life. But without all that, you got a lot of geopolitical tensions going on. You got terrorists attacking ships, cargo ships in the Red Sea, stopping trade there, almost halting trade. You've got all sorts of stuff going on. So folks, like, when you really think about this, it's not just the US, it's not just you, it's the world is in turmoil. We got conflicts everywhere. So what's going to happen? Well, I don't know. I can't predict the future, but I can kind of guess. We're probably going to see a recession inside the next year, so might as well get ready for that. With the port closures and all the strikes going on the East Coast ports, you're probably going to have some food shortages. Better stock up on that toilet paper, because we all know toilet paper is more important than canned peas and all that good stuff. But while you're at it, we're going to talk a little bit about how to get your financial house in order so that you can afford more food to stock up for 3 months, so you can afford things when everything gets a little bit crazy. And when we go into a recession, you got some money that you can deploy into the opportunities that come out of every recession. Because I don't know if you all know this, but during a recessionary period, or we'll just call it an economic slowdown, there are opportunities everywhere. The problem is the majority of folks don't have the ability to take advantage of opportunities because they pushed all their chips in when the markets were doing good. So when the markets weren't doing good and they went down, all of a sudden they're like, well, I don't have any money to invest. Right when they should be investing. Right now is not the time to invest. Let me repeat that just so you all hear me, and I'm being very serious. Right now is not the time to invest for growth. Everybody got that? This is the time to preserve and protect. There are times for growth and there are times to preserve and protect. And you know what? We can banter back and forth about that, but you know what? That's a final conclusion. And I said it earlier, and I'll say it again. I can't understand why folks that think, yes, we're going to have an economic slowdown. I mean, actually, how about this? Let me pause and transition. We got almost 100 people on here. Who is on here for the very first time? Put I in the chat. I just want to know who our newcomers are. I love new folks, and I love really kind of bringing them into this, because this community has been around for a while, folks. We've been doing this webinar every single week for years now. I don't even know how many years it's been, but every week for years we've been doing this. So when we get new folks on here, and that's awesome. We got Rod, brand new. We got Thomas, Christopher, welcome. Thea, we got, sorry, they're going in quick. I think I said that right. Rebecca, we got Caesar, we got Deborah. Let's see, we got John, we got Servando. Did I get that right? Servando, Patrick, Tia. Oh, yeah, Tia. Tia, why wouldn't I have known that? I just did a big thing this weekend for another Tia. Awesome. Well, hey, and RJ too, welcome to all of our new folks. Just so you know a little bit about what this show is, the Wealth Webinar is a place where we teach you how to take back control of your money by teaching you how to be the bank, but we also teach you how to prepare for what's coming. And we also want to make sure that not only are you getting control of your money, not only are you learning how to be your own bank, the infinite banking concept, but also what do you do with the assets that you have now? What do you do with those 401ks and all those other things? Now, we don't manage money for anybody. And I want to preface that. We do not manage money. We are not financial advisors. Therefore, when you signed that disclaimer coming on, it said we do not give investment advice. However, I'm going to show you some things that your financial advisors should already know, but probably aren't talking to you about them because you know why? There's no money in it. And that's the truth of the matter. What we're going to go over today and what we always go over are usually things that your financial advisor, your trusted advisor will not talk to you about because, well, there's nothing to sell. And not only that, there's no money in it. This is teaching you how to be a good steward of your money. Fair enough? All right, so what I want to do, and also too, I love this. We got a bunch of comments, or not comments, questions coming in. If any of you have any questions, comments can go in the chat. But if you have questions that you want us to address, please put them in the Q&A. Stephen, anything I missed there that you want to hit real quick before we get rolling?
Oh, awesome intro.
All right, so here's what I want to talk about first. I want to talk about where we're at, okay, right now. It is not hard to see that we are in an economic slowdown. That's the cycle that we're going into. We were in an economic expansion period for roughly about 15 years, heavily promoted by lots of money printing, artificial money printing, artificial rates being held in incredibly low interest rates. So money was easy, there was lots of it, and interest rates were cheap. But I think you all will agree, none of that exists right now. Money is expensive because the Fed raised rates really fast, although they are decreasing them now, which we're going to talk about. But they raised rates really fast, which drove up the cost of things. But well, actually, inflation drove up the cost, but then the cost of money to buy things like cars and houses and boats and all the things you would finance got really expensive. So we had an inflationary problem. We have a cost of money problem. And right now, we just have a damn cost of everything problem because inflation drove the price of everything, including food, up somewhere around 25%. Did your income increase 25% in the last couple of years? Chances are it did not. Now, if it did, awesome. You are one of the few. But you know what? All of you are one of the few because you are all part of the 5%. Because here's the thing. You're here willing to put your time, your energy, and your effort to learn something new. The other 95% are out there just thinking everything's good, nothing's wrong. They're just going about life. You're different. You're the 5%. And Earl Nightingale in The Strangest Secret in the World talks about this. And he says the difference between success and failure is simple. Successful people create. All of you are here to create something. You're here to create a solution to your problem. You're here to learn something new. You're here to learn about how to be the bank and how to take back control of your money. You are here to create your financial future. The other 95%, guess what they're doing? They're just conforming to what other people are telling them, conforming to what CNN is telling them on the news, conforming to what their advisor is saying. Oh, it's just a paper loss, no big deal. Oh, we'll be fine. You can ride it out. Oh, you can't, time the markets, which they're right in saying that, but you certainly can protect your assets instead of timing the market. So those are some of the things you're hearing, but I want to get down to it, and I want to really kind of just go into one of the most important things. And I talk about this a lot. So folks, if you've been around this campfire for a while, which is a whole bunch of you, I know this is a repeat, but I'm going to be able to show you some things that even if you've seen this, what I'm going to show you is proof of the pudding. Last night in the debate, one of the common things that I heard, and I heard both of them saying that, but they said the proof is in the results. The results, like what happened in the past. You can see those were the results. It's concrete, it's ironclad because we have witnessed that happen. Well, I'm going to show you the proof. So Warren Buffett has some of the simplest quotes when it comes to investing. He takes a very complicated investment strategy and brings it down to the simplest form and just says, to make money, all you need to do, and actually, hold on, I don't want to tell you what to do. I want to ask all of you, what does Warren Buffett say? What are his 3 simple rules to making money in investing? Who can tell me? 3 simple rules. It starts with, yep, there you go. We got it. Buy low, sell high, and don't lose money. So Tess got it, Drew got it, and everybody was chiming in. James, good job. Buy low, sell high, and don't lose money. So let me go to a chart here. Let me see. I know I've got one here somewhere. And, I kind of just draw these. Let me just ask everybody, and you can all kind of just answer, yourself. If you're in your office, just scream it out there. Yeah, don't do that. But where should you buy? Should you buy here? Stephen, should we buy here? What do you think? Right there?
I probably would not.
How about here?
Oh,
Or here?
in reality, it depends on your strategy. So if you're just dollar cost averaging in always and forever, then yes, yes, yes. If not, then no, no, no.
What if you just got a chunk of money and you're like, oh my God, you got a settlement or you got an inheritance and you got all this money and you're like, oh, where do most people invest? Do you think they invest here or do you think they invest on the downward side, the upside or downside? Where do you think most people when they get, yeah, right. Because it feels good. It feels good. So when you invest money, most people will invest when everything is going up because it feels good. And guess what the markets have been doing outside of the last few days? Going up, setting new highs. So it's a feel good. Oh my God, I'm missing out. The fear, the feeling of missing out on something. And that is what most people do. It's human emotion. They buy when it feels good to buy. Not when it's the best time to buy, but when it feels good to buy, which defies what Warren Buffett said. Because Warren's very clear about it. He said, buy low. Buying low, which you're never going to get the bottom and you're never going to get the top, but buying low would be buying on downward slopes, right? So let me come back over here. And these are just two axes connected in the middle. He said, buy low. So here's one of the things I can tell you is a really unique place and a really unique thing to buy low. And all I'm going to do is I'm going to share my screen and I'm going to have a pen and I want all of you to play into this. So Stephen, can you watch the chats on this? We got a bunch of people chiming in. So hold on a second. Everybody, if we're going to buy low, is this where you'd buy? How about here? Here? Somewhere around here. Where would you want to buy? Of course, everybody's like, I would buy right here. Yeah, but you missed that because that's in the past. But how about right over here? How's that look? In retrospect, with everything on this chart, and you don't need to be a chartist or know anything about, you don't even know what this is that I'm showing you, but I'm just kind of pulling it out. All of this is the past, okay? That's all I'm going to show you. This is all the past. And if I were just looking at this, I would say, well, these are all pretty high, and these over here are all pretty low. Can we all agree that these would be what I would determine as high price? And just by simply looking at, I'm not even pointing anywhere, but this is kind of low, right? Does everybody agree with that? The highs and the lows? Okay, so as long as you agree with what I just said, now let's talk a little bit about what is it that we're actually looking at here. Well, if I, come up here. If I scroll up, we are looking at United States 30-year Treasury bonds. So one of the most elementary, boring, stupidest investments out there, but one of the most liquid, highly sought after places you could ever put money. And then here's the charts, if we kind of, depending on how we blow them up, this is kind of what I did before. So is this the lowest point in time to buy? No, I would have preferred that once I was talking about this, you had bought somewhere down here, which I was telling you to buy here. Okay, I was telling you to buy down around here. It was about 80, 90 bucks when it was down around here, okay? However, most people didn't buy here. Most people feel good when it's doing this. And when it's doing this, guess what's happening? When the price of interest or this particular 30-year Treasury is going up, what is happening? Well, when price is going up, interest rates are going down, okay? So when the price is going down, interest rates are going up. It's inverted, right? It's backwards. So as long as you understand that, all I did here is I just said in the simplest form, price goes down when interest rates go up. Can anyone tell me when that happened? When did interest rates go up? The last couple of years, right? Interest rate went up. So based on what I just showed you, when interest rates went up, what happened to the price? It went down. So if that's all we knew, if we knew, well, every time I see on the news that the Fed is raising interest rates, I know that those stupid 30-year Treasury thingamajiggers, those IOUs to the government, they're going down in price. So if Warren Buffett says buy low, well, then I would just wait for the Fed to increase interest rates and I would buy low. Well, guess what? That just happened. Matter of fact, it's not too late because it's getting too late because guess now, well, now let me ask everybody the other part of the question because Warren Buffett said buy low and then he said sell high. All right, so if you took that advice, those Treasury thingamajiggers, I bought them when the Fed was raising interest rates and I bought low, says Chris, and the rule. But now Jerome Powell, I know on September 18th, just reduced interest rates by 0.5%. So if he reduced it 0.5% there, he said, I think I remember in that dumb article that he said he was going to reduce them another 0.5% maybe by the end of the year. So that would be a 1% decrease in 2024. And then in 2025, they also said that they were going to continue to decrease them. And the word on the street was maybe another percent in 2025. So if the Fed is going to decrease interest rates by 2% over the next year, a little less, a little more than a year, well, then I know the price of those bonds is going to go up. Everybody got that? Simple. It's an arrow. Interest rates up, price down, interest rates down, price up. So it's the simplest thing in the world, because all you need to do to buy low, sell high, and not lose money is just do that. Buy low. So when the Fed raises interest rates, you buy treasury bonds long term. When the Fed decreases interest rates, you sell treasury bonds, and you don't lose money. How many of you want to lose money intentionally? Is anyone here to lose money? Put I in the chat. Anyone? Nobody here? Nobody's here to lose money? Okay, well, good. I got the right group. I'm serious. Like, some people literally, like, they just want to lose money. Maybe they need a tax write-off. Who knows? Maybe they just listen to the wrong people. But if all of you understand that that's a pretty simple solution, well, let me show this chart again. And what I'm going to do is I'm just going to go to year to date, and I'm going to share this screen. And now that you know what we're doing here, then we're going to come back to my little drawing. If you know what we're doing here, well, then if we couldn't have bought when the Fed was decreasing interest rates, which was this period, okay, that was when they were decreasing them, and then we didn't know what was going to happen there, so they came up a little and they decreased them. But now we can buy them right here. So how much can we buy these little buggers for? Well, let's take a peek. How much can we buy these treasury bonds for? Whoops. Well, let's see. Where is the price? So it looks like the price is $101.84. Okay, so $101.84. So if I looked at this thing, is that a good price? If I just look, if I know nothing else, if I know the price is 101, well, then I must assume if this is 101, what the heck would this be? And I'm not going to give you the number. That's why I use this chart, because this chart just shows yield. I'm just trying to show you the price. So if the price here is 101, the price here must have been what, like $1.50, $1.60, $1.70. Some of you are like, I don't know what it would have been, but you do know it would have been higher. Okay, so if the price is here, and we know that the Fed just decreased, just decreased interest rates, and this was the impact. Okay, what happened here? The price went up. Well, duh, yeah. The price of the bond went up because the Fed dropped interest rates 0.5%. So if the Fed drops interest rates another 0.5%, could we expect a similar move? Yep, I would say probably go to about here. How's that looking, folks? If you could buy here and sell here, would that be a good day for you? It wouldn't be a bad day because you'd make a little something. How much? I don't know, maybe a couple bucks a share, $5 a share, not terrible. But then next year, you know they're going to decrease another percentage. So if we just kind of did this, and you could almost just like take your pinky finger and you're like, all right, well, that was that much and that one's that much. You ever do that when you're trying to measure something? You like take your arm and you're like, okay, you line it up against the wall and you're like, okay, that's my elbow. And then you come over here and anyone do that? I've done that too. So I'm kind of doing the same thing, but on the screen, if we can assume that, well, then another interest rate, another 1% interest rate would probably bring us somewhere around here. Now, if this is 101 way down here where we're at today, up here's got to be like $1.40. So can anyone do the math for me? If this is 140 and down here is 101, how much did you make? 39 bucks a share. Okay. So if you could buy the shares for 101, how many shares could you afford to buy? And would you like to make a 39%, or sorry, $39, because it's almost a 39%, but a $39 increase per share you buy? I don't think anyone in here would complain about that. I have been trying to drive this conclusion home to make it very simple. And now I can show you the proof, because the proof of the pudding is in. Like, the records are in right here. We did this. This is an old 3-day money school essential training that we did in March 1st of 2024, where I was telling people the exact same thing I'm telling you now. Now, all these people paid money to be in this 3-day, so they got an early jump on this, because back then we could buy these things for $96.97. How much are they now? $101.84, which is when I wrote this today. They're $101.84. The yield, the percentage you earn, because, hey, listen, you don't just make money. This isn't like buying a stock and then you have to wait for it to appreciate, you get paid the whole time too. I forgot to tell you that. Because you're basically doing a loan to the United States government when you buy a 30-year treasury, the United States government pays you interest. And back in March, they paid you 4.34. However, now they'd only pay you 4.25. Well, but that's because the price went up. But we had a price increase of $4.87. It's been 215 days, if I did the math correct, between 3/1 and 10/2. It went up $4.87, and the Fed only decreased interest rates. Well, the Fed only decreased interest rates by 0.5%. Are you seeing how this works? So what I'm trying to do, folks, is I'm trying to just get you to understand it is way simpler than your advisor makes it out to be. It is way simpler than other financial gurus and analysts and Jim Cramer, who gets it wrong every day. So if you want to be wrong, just take Jim Cramer's advice. If you always want to make money in stocks, I got the best tip ever. I don't know if I should give it to you, though. Steven, should I give them the best stock picker in the world on who to follow?
Why not?
Normally, folks, people pay me a lot of money, but I'm feeling pretty good today. I'm feeling pretty good because I think some of you are going to probably join us out in Money Tank. So I'm just going to give it to you. If you want the surefire pick, if you want to buy a stock and make sure that you sell a stock and make money almost every single time, you sure I should give this to them? I don't know. You guys really want it? It's not what you think, but you sure you want it?
Maybe next week.
Yeah, maybe we'll just give it to them next week. It doesn't seem like they say por favor. What is that? Is that no hablo español? All right, fine.
All right, you're getting some comments.
You drove a hard bargain. All right. So there's this person that you all probably know. Maybe you like her, maybe you don't, but her name's Nancy Pelosi. And there's actually a site. Stephen, can you pull that site up so that we can give them the real goods? There's a site where you can go and it will tell you every stock that Nancy Pelosi is buying and what stock she is selling. They literally track her buys and sells. Now, just so you know, you all know who Nancy Pelosi is. We'll leave it at that. So Nancy Pelosi is single-handedly the greatest stock picker of all times. Warren Buffett literally should kiss her shoes. That's how good she is. She doesn't need fundamentals. She doesn't need to go in and do analysis. She doesn't even need a team. It's called insider trading. She just gets the information before it ever hits the street. She buys the stock before it even comes out, and boom, she makes money. Her husband goes in and sells it. And for some reason, it's illegal for me and you to do that, but it's not illegal for her. So by that, it's not illegal for you to just copy what she does. You see, folks, I just gave you the greatest stock picks of all time. And Stephen, did you put it in the chat? Right there. Look at that. This is not financial advice, but literally, like, we're not giving you financial advice. We're just telling you to follow the greatest stock picker of all times, Nancy Pelosi. There it is. If you just buy the stock she buys and sell the stock she sells when she sells it and when she buys it, you're sure to make money. But all right, I know that wasn't what you all wanted, but you know what? Yeah, there you go. Look did someone just say they made $500,000 lately? Frank, did you make $500,000 following Nancy Pelosi's stock picks? You did, you dirty dog, you. Anyway, but if any of you don't want to do that, this is another great way to do it, because here's the cool thing. Go ahead, Stephen.
Well, I was going to say, just to kind of give you guys an idea of how powerful this really is. So this was their most recent. This was from an hour ago.
People think we're joking right now, though. That's the funny thing. Like, you see the comments, they actually think we're joking. They think that was all a joke. There's no joking here at all. Like, we're dead serious. Go ahead,
yeah,
Steven.
you just track them. So back in October 2023, they made a $50,000 buy on Raytheon. Raytheon's the defense company behind Israel's Iron Dome. Right before October 7th happened, that was a couple weeks before the invasion of Israel. Just happens to sit on the Senate Armed Services Committee. Stock is now up 70%. So this stuff works if you just follow what they do.
I mean, wouldn't that be good to know? You know, like Raytheon makes some stuff for the Iron Dome. I mean, my guess is just in the last couple of days, the Iron Dome's had to send quite a few rockets, interceptor rockets, up into the sky to intercept those missiles that Iran sent over there. And I mean, I don't know, what do you think those interceptor missiles cost? I mean, $100 each? You know, I think a shotgun shell is probably like, how much are shotgun shells now? A couple bucks a shell? So I mean, that missile's got to be what, couple hundred, couple thousand, couple million? I mean, they got like that radar guy. Now they must be a couple $1 million a piece. So
Well,
if you,
you probably do it for a couple thousand, but the government's going to pay a couple million for them. So that's okay.
silly me. Yeah, because duh, that makes more sense. Stephen, God, I missed that. Let me see what you got here. I mean, if Raytheon's making them for a couple thousand, they're selling them to the government for a couple million. And well, Nancy Pelosi's husband sold more than 500,000 in Visa stock ahead of DOJ action. I mean, listen, like this, we're not making this stuff up. It's right here. This is Fox Business. So anyway, I know you didn't come here to get the best stock picks. So let's get back to the basics. And the basics are IOUs for the United States government. If you've got money, folks, and you've got it in a 401k, you've got money with Charles Schwab, you got money with Raymond James, you got money with your advisor, your trusted advisor. Listen, just have this discussion. Just say, Mr. or Mrs. Advisor, listen, I don't want to lose any money. And I don't like what I'm seeing. We got an election coming. You know, we got Iran firing missiles into Israel. Israel's going to be firing missiles back into Iran. Some shit's going down. I just really don't want any part of any of this. So, you know, I'd like for you to take a portion of my portfolio. And folks, I can't give you investment advice. So you pick the portfolio percentage. I'd say more than versus less. And I'd like you to go out there and find me some of those stupid 30-year U.S. Treasury bonds. And I don't care if you do it in an ETF, because I know that's easier than going to treasurydirect.gov. So get me some of those 20-plus year Treasury bonds, because I think when the Fed drops interest rates, the price of those are going to go up. And oh, by the way, Mr. Trusted Advisor, I'd like you to sell them when the price goes up. You know, por favor. That's all you need to say. But if you don't have an advisor, you don't want to talk to your advisor, that's easy. Then just go to treasurydirect.gov, buy 30-year Treasury bonds, or go into your Schwab account and you can look at, I don't know, there's a bunch of ETFs that are, just Google right now. Here, let me show you how to do this. Since I can't give you financial advice, the one thing that I can do is I can just show you how I do it. All right, so here's what you would do. You would go to Google, and folks, if, whoops, not giggle. All right, you'd go to Google, and you may or may not have heard of that company yet. Google, that'd be a good one to buy like 20 years ago. There we go. All right, you go to Google and you just say, let's see, I want long-term Treasury bonds, but I want to buy them in an ETF. There we go. And what's going to happen? Well, a bunch of these things are going to come up and you're just going to go in. All right, well, which one do I want to buy today? I don't know. What's this one here? iShares. Okay, and you find iShares. Let's see, required only. iShares 20-plus year Treasury bond. Folks, I'm not like, this wasn't preempted. I just literally just picked one. So these are Treasury bonds from the United States government. So this ETF, this company, iShares, investment company, buys Treasury bonds. You can come down here and you can kind of, somewhere in here, you can look at kind of what they're buying, why they're buying it, the ratings and everything else. Yeah, here we go. Prospectus, fact sheet. Make sure you read the full prospectus, but you can come in here and you can pull up a fact sheet on it and it'll tell you, here we go. What are the top holdings? Oh my gosh, surprise, surprise. Treasury bonds, top holdings, Treasury bonds. Wow. SEC 30-day yield, 4.5%. So you make 4.5% of your money, not too shabby. So right here, the NAV total is 2.67%. But over here, we can buy it for $98.46. So you could show your advisor this. Now, your advisor might fight you on this, well, because they're boring. That's why. They're like, oh, that's stupid, blah, blah, blah. Look at this. Look at the returns. And last year, you lost 7%. If you owned this thing for 3 years, you would have lost 11. If you owned it for 5 years, like that guy, that Chris guy, he's an idiot. Hold on a second. Hold on, Mr. Smarty Pants. Total returns. Like this is what people, this is how silly and dumb this is. This is what advisors would look at. They would go back in time and they would tell you that like, oh, well, these are the returns that just happened 1 year, 3 year, and 5 year. Now, hold on a second. What happened in the last 3 years? Was the Fed increasing interest rates or decreasing interest rates? Stephen.
The Fed has been increasing interest rates.
And what did I said happened to the price when interest rates went up? Sorry, I gave you the little thing. They go down, right? The price goes down. So wouldn't that just make sense that it lost money in the 1, 3, and 5 year? The 5 year, and some are like, well, wait a second, in 5 years, the Fed wasn't decreasing rates. This is an average over 5 years. So you can see it's right here, a blend, 7, 11, 3 years is the heaviest increase. So of course, that's your heaviest loss. But we're not talking about buying high, folks. We want to buy low. So what you'd want is to buy something that was losing money the last couple of years that is now not going to lose money and going to go up in money. And that is super duper duper easy to see right from what I'm showing you. And your financial advisor should be able to look at this. So we can kind of just come over here and we can say, all right, 10 years. There's a 10-year chart. About as simple as it is. That's high. This is low. Okay. Any questions about that? High, low. There we go. Where are we buying? Just slightly above the low. Okay, because you missed the low. You didn't come to the 3-day money school essentials. So if we buy it here, do we think it's going to go here or here? Yeah, we do. We do think it's going to go up to one of those two prices because it did already. And if it's on the move up and we know the Fed is decreasing interest rates, well, then it must go up. Now, I don't want to waste any more time on this, but does anyone have any questions on this? I mean, this is just pretty simple stuff. You buy low, you sell high, and you don't lose money. Stephen, does anyone have any questions?
No questions specifically on that. By the way, guys, I'm trying to keep up with the chat box, but it moves fast. So if you do have a real question, put it in the Q&A, and I'll make sure we don't miss it that way.
All right, so now that we're done with that, let's move on. And sorry, I beat that one to death, but that's like the fundamental, right? That's kind of the fundamental. We're going to get to these specially designed whole lives and IBC, but I'm just taking it because listen, some of you have new income coming in and you're saving money. We're going to talk about that at the end. Okay, we're going to talk about where new savings should go. But what I'm trying to do is give you a fundamental baseline of like, where do your existing investment assets go? How do you not lose money? How do you preserve and protect? How do you get ready for the doomsday preparation? Well, I just gave you that. Preserve and protect the money that you have, which means sell high and get into something that protects your assets. I just showed you how to do that. So now let's go to the next thing.
Real fast, before we move on, there are a couple questions. So why TLT ETF? Why not an index fund that's tracking long-term treasury bonds?
I literally, TLT was literally just the one that I grabbed. I mean, you can buy TLT. I own TLT. I own ZROS. You could research them all. My gosh, why just have one when you can have a bunch? There's not just one ETF. I mean, TLT, what I like about it is it's got an average of 20 plus years. But I got a whole thing in my notepad here, which I can't give you because I'm not allowed to give you financial advice. But I got this whole thing in my, let's see, ETFs. Where is it? Treasury bond ETFs. So I got this whole thing of all the ETFs that I've been buying. So just like you were saying, like if you got other ones, like why not an index fund that tracks long-term treasury bonds? Well, that's kind of silly because treasury bonds are kind of like an index because it's not like someone's managing the treasury bonds. I mean, that fund that you just looked at, it's an ETF. And if you know anything about ETFs, all ETFs are indexes because they're not actively managed. An ETF by nature, and maybe I'm wrong, might be actively managed ETFs now, but most ETFs are just passive and literally just indexed. So, but yeah, check them all out. Look at them all. Find which ones meet your needs and goals and find which ones that you like. And then those are the ones that do.
Yeah, FMBGX, Andy, it's Fidelity Long-Term Treasury Bond Index Fund.
There you go. I mean, just look at the holdings, look at the prospectus, look at the fact sheet. What are they holding? The only thing I would urge you, if you're trying to do that strategy I just said, you're looking for longer duration. So 10 plus year on the duration side. So I can't remember what the Fidelity one has. I've looked at that one numerous times, and it's probably in that little hit list that I had there. But listen, I'm not saying one is better than the next. They're all good because they all have treasury bonds, and treasury bonds are treasury bonds. Like it's a rabbit is a rabbit, it's a rabbit. Like it's not a woodchuck, it's a rabbit. So just go out there and get yourself some rabbits. All right, what do we got?
And then the only other thing, let's see, what do you think about buying and holding a stock for years?
Listen, that's great, but can I use that? Who said that?
Mark.
All right, Mark. Hold that question, and then I'm gonna have you ask the same question after I get done with this very next part, because I kind of want to know your opinion. Like, what do you think about buying and holding the stock for years? Great, but just know what you're going to be in for. And you weren't on WTF, so I'll use the nut kicking example in a little bit. What else do we got, Stephen?
Last one kind of ties it in. How does this is the time to preserve and protect, quote unquote, affect private money lending and private money?
Great. I'm definitely going to hit that, James. As a matter of fact, I get through this next section, and then I'm going right where your mind's going into private lending because I love it. I'm still doing it, and we're going to talk about how to preserve and protect a little bit more with private lending. All right, so let's come over to that one question. Mark, I believe Mark had that question about what do I think about buying a stock and holding it for years. So here's the thing. The market works in cycles. Very easy to see if you know what you're looking at. The market goes up, and then the market comes down, and the market goes up, and the market goes down. But over a long course of time, the market always goes up or has always gone up. Okay, so as long as we can accept that as the reality, market goes up, market goes down, but in the long run, market always goes up or goes higher, then we're good. But let me ask you this question, Mark, and everybody else that's on here. Why would you buy a stock today knowing you're buying at all-time highs? And I'm not saying every stock is at all-time highs. Some of the Russell small cap stocks are a little, properly valued. They're not exorbitantly overvalued like the S&P 500 and all the Magnificent Seven stocks. But why would you buy a stock today knowing that you have it high with the intent to hold it for years when you know this is coming? When you know the downturn in the market is coming, and here I'll just give you a little bit better drawing. When you know this is coming, and you know all boats go out with the tide, all tides are going down, right? So when the tide goes out, all things go out with the tide, and when the tide comes in, all things go up with the tide. So what I'm saying is every single stock, even Apple, Nvidia, all of them, when the markets are going up, they're going up. When the markets are going down, they're going down. I think we can all agree on that. So Mark, if you bought a stock now, okay, let's just say X marks the spot, and you plan to hold it for a couple of years. So let's just say this is a couple of years over here, okay? So we'll say I plan on holding this stock for 5 years. The probability of your hold looking like this is pretty big. So you're going to buy the stock here. You love the stock. You're not worried about holding it for a long time. It's going to ride this roller coaster down, and then it's going to come back up. And even let's just say, hold on, let me change that, Mark. Let's just say it comes back up in a couple of years to right where you bought it, okay? So you buy it at 100, it goes down to 50, and then it comes back to 100. How much did you make? Nothing. How many years did it take? 5. What did you have to go through in those 5 years? Well, Mark, here's what it kind of looks like. I'm going to use this, all right? This is going to be kind of funny. Hopefully this works. Mark, you're a man, so you have those things between your legs. We'll call them balls, okay? And that's, sorry, women, I don't mean to get graphic here, but basically, this is what it would feel like to hold that stock for the next couple of years. How do your balls feel? Just asking for a friend. That felt good, Steven. That felt really good. I mean, do you really want to get punched in the balls over and over and over again just to say, I bought that stock and I planned on holding it for years? It just doesn't make any sense, Mark. Like, we can buy the stock down here. We can buy it here. We can buy it here. We can buy it anywhere. But if we buy it here today with the intent of holding it a couple of years, well, hopefully that visual was good enough. You're going to ride this. That's the first time I've ever done that. I like that. I think that kind of, did everybody think that kind of told the story?
I think so, yeah, definitely.
I hold it in. Oh, what was the movie with Jim Carrey where he's like, I don't know, that's where I got that idea.
Liar, maybe?
Liar, or whatever it was. All right, so Mark and everybody else, what I'm trying to do is I'm trying to help all of you create a bridge. Because why would we want to go down in the canyon, cross the river, and climb back out of the canyon when right down the road is a bridge? When all of you drive in your cars and you're going somewhere, do any of you, like, you're heading toward a big river? We have the Niagara River here, and there's the Grand Island Bridge that goes over it. Have any of you ever been like, screw it, today I don't feel like going over the bridge. Just don't. You drive your car over to the edge of the water, you push it into, you hit the gas, you go in the water, car sinks, you get out, you got to swim all the way across the river. Then you got to find a way to climb out of the river. Then you got to go up and steal a car because your car's in the bottom of the river. And then you got to drive. Did that sound easier than just driving over the bridge? I'm just trying to teach you how to create a bridge. Because here's the other thing, and this is the only point I'm going to make with this. This is what people are not considering. It is called the drawdown effect. It's never been any different. It just is what it is. If you lose 10%, so if you bought a stock or had stocks and you said, I'm young enough, I can ride this out. And I hear this all the time. I'm young, I can weather the storm, I can ride it out. I'm just like, yeah, but Why would you? Remember the punching bag? That, brrr, bing. Like, remember that? Why would you? Because if you lose 10, you got to make 11 to get the 10 back. But if you lose 20%, which is highly likely, and I'm going to give all of you, I know it's been a long time since we've had a downward market. It's been a long time since we've had a recession. Most people don't even remember the recession, and we can't count the pandemic. That was kind of just like a, I don't know what that was, knee-jerk thing, but you probably don't even remember a recession. You don't really remember what it felt like. But when it goes down, it sucks. Emotions get in there. And Mark, my bet would be if you bought a stock with the intent for holding it a couple of years, I bet you wouldn't make it those couple of years. Because if it got really rough, like if you went down 30, 40, 50%, I bet you'd sell. I've seen this happen. I've been in this business 21 years. And what I see people do is they have the best intentions going into it, and then all of a sudden it happens, and then they're like, oh, I can't lose any more money. Gosh, it could go to zero. I gotta get rid of it. And they sell it at a loss every single time. And here's why. Because they know then once they're losing, if they lose 10, they got to make 11 to get it back. If they lose 20, they got to make 25 to get the 20 back. If they lose 30, they got to make 43% just to get their 30 back. And if they lose 40%, you got to make 67%. If you lose 50, whoo, you got to make 100%. I'm going to repeat that. If you lose 50% on a stock, that stock the next year has to make 100% just to get back even, okay? It's called the drawdown effect. Look it up. All right, so there we go. All right, so any questions on this, Stephen? Did anyone have any questions? Because I want to move on to what James was talking about, private lending. All right, let's just say private lending. So you got some money, you wanted to move, you already bought those dumb, stupid treasury bonds, even though your advisor said that's stupid, you shouldn't be doing this, but you said, I don't care, I want long-term treasury bonds. So you got a couple treasury bonds, you're happy there, but you still got some money. And you're like, I don't know what to do. Great. Well, I always tell people, I said, one of the things we teach about taking back control of your money and being the bank is, well, what do banks do? I mean, they're probably the smartest that you can get when it comes to money. So what do banks do every single day? Well, banks have convinced us all to take our money, go in the bank and deposit our money with them. They then take our money and they lend it out at a higher interest rate, just so you know. They pay you like 2, 3. I bet you a bunch of you wish you were getting 2 or 3% in your bank account. And then they lend it out at what? 5, 6, 7%. They make a nice little spread. So if that's what banks do, and I want to be the bank, so I'm just going to kind of write what's on my shirt and hat, BYOB, and I want to be the bank, well, all I would do is I would go out and do what a bank does. Now, conveniently for you, we have created this thing called Private Money Club. Now, Private Money Club, just so you all know what it is, it's very simple. It's kind of like Tinder or eHarmony or what Match.com. It's like a dating site. You kind of know how these work. Like, I don't think anybody on here needs to be told how a dating site works. Men join, women join. They kind of go on there. They look at the reviews. They look at all the stuff, and they're like, hey, I like your photos, especially that one. You know which one. Would you like to go out for dinner one day? And the other person says, hey, you're kind of cute, and I like that photo. Yeah, that one. Yeah, let's go on a date. So you meet out for dinner. Okay, you do some discussions, and then maybe whatever happens after that. Great. You understand how a dating site works. So Private Money Club is just like that, except for we're not going to talk men or women. We're just going to talk people with money are going to meet people that need money. And they're going to come together, and they're going to not date, but they're going to do deals. They're going to do lending deals, and both of them are going to make money. Beautiful thing. So that's Private Money Club. It's privatemoneyclub.com. Oh, by the way, I mentioned this earlier, but I'll hit it again. November 8th and 9th, we've got a really amazing event that all of you should go to. And it's going to be even more amazing because it's right after the election. It's going to be a wild time. But what we did is we rented out a racetrack out there in where is it at, Stephen? Charlotte?
Charlotte.
Okay, so it's out in Charlotte, South Carolina?
Oh, North Carolina, yeah.
North Carolina. I always confuse that. So Charlotte, North Carolina. And we rented a racetrack, and we're doing an event. And the only people that will be at this event are one of two people with money, and there's lots of those coming to this event, and then people that need money. And then people that have money meet people that need money. People that need money pitch their deals or talk about their deals to the people that have money, and the people that have money meet them. So now they're like, hey, this is cool. Let's get our attorneys talking, our title companies talking. Let's do this deal. And they do. So private lending, okay, is a really, really good thing. And all of you can get a ticket for this event right here, right now. So let me just kind of give you a little gist on what these are. And I'm just going to pause for a second. So the general admission tickets are $697. But today, we're going to give 10% off, but most importantly, forget about the 10%. That's just like barely anything. We're going to take out of the $697, we're going to take 20% of that. And we're going to basically give that to a charity that's going to help those that were affected by this hurricane. And just so you know, we're in North Carolina. The Carolinas were affected huge. And so were lots of other states and lots of other families and lots of other animals all need help. And we're going to donate 20% of your general admission ticket or your VIP ticket to a charity. Okay, so you're doing good because people need help right now. They need a lot of help. It's a tragic thing that happened with that hurricane, and that was a nasty, nasty one. And the rainfalls in Ashland just devastated things over there. So we're going to give 20%. So $697 for general admissions, 10% off that brings you down to $624.60. Okay, and then you're just going to put when you click book ticket. What is the code they're going to put in there? There you go. Secure your ticket. But there's a lot of things you're going to learn. We got a bunch of great speakers. But the other thing too that's really unique is if you were able and you wanted to do the VIP, you're going to have what's that? There you go. So you just click.
And then you can even bring a guest with you for 50% off. So we're doing a BOGO 50% off sale.
There you go. So bring your wife, your husband, bring your kids. You get 50% off all of them. So there's how it looks. Okay, so you just sign up. And if you wanted to do the VIP, we've got an exclusive event. In that event, we're going to go to a race. That's right. We're going to go watch race cars. It's going to be super fun. You're going to be around really, really good people and people that will want to solve your problem. The only downside is they wouldn't let me bring my cars. I tried. They wouldn't. I was kind of pissed. So I'm like, fine, you'll have cars there. We'll just deal with it. So anyway, hopefully a bunch of you are going to join us at this event. This is the last Money Tank event of the year. The links are in there. Just remember MCM, I think that's what it was, MCM Money Club Monday is the code to get the 10%, and it doesn't matter. You don't need to put anything. 20% automatically goes to that charity. All right, so got that out of the way. All right, so let's come over here, private lending, back to it. So you got some money and you want to mimic a bank and you want to do what a bank does. So we go to Private Money Club, we find a deal. Now on Private Money Club, and Stephen, maybe you could pull up some of the deals on Private Money Club. The average deal right now on PMC is about 12 to 15% interest. I like first position deals, but I've done second position. So first, second position, whatever you want, you can lend your money to them. Now, there are some things you're going to need to get in place to do this. So first off, if you find a deal you like, don't ever, ever, ever send your money as the lender direct to the buyer, okay, or direct to the borrower. You send the money to a third-party escrow. Okay, so this would be like an attorney or a title company. So let's use a title company because most people are familiar with them. So your money goes to the title company. The title company verifies that there's a note, which you would structure. You and the borrower would structure a note. The title company and their attorneys will help with the deed of trust or the mortgage. And then the only thing you got to do is say, hey, Mr. Borrower, I need insurance so that if this thing gets swept away in a hurricane, I get my money from the insurance company, not you. So note, mortgage, and insurance, naming you additionally insured. Great. All that gets done. The day of closing comes, title company records the mortgage. So now you as the lender are in first position, which means this person that owns this house that you lent the money to can't sell the house, refinance the house, can't do anything with the house until you're paid back your money. Actually, not just paid back your principal, paid back your money plus your interest. So that's how that works. Then they give the money to the borrower. The borrower takes that money, the interest, and sends it back to you. And then you take that money and you buy more treasury bonds. Just kidding. But this is still a viable opportunity. And it will be straight through any recessionary period. Because all that will happen is the price of the asset you're lending on will go down. That's it. Okay, or up, whichever cycle we're in. Sometimes it goes up, which you hope. Sometimes it goes down. So all I would say is if you think the price of real estate is going to go down in this strategy, all you want to do is whenever you're lending, let's say they're asking for 200,000 and it's got an ARV of 300,000. All I would do is I would discount this ARV by 10 to 20%. Because if we look at the average, if we look at 2008, which is a good barometer to look at, and you look at what the average price of a house fell nationwide, build that in, and then just don't lend up to that. So make the borrower come out of pocket a little bit more money, and then you're protected. Because if all things go to hell in a handbag and you got to foreclose, which I've not really seen, I've never had to do a foreclosure for anyone I've lent to. I'm not going to say it's not going to happen, but up to this point, I've never had to. But even if I did, if I had a house worth 300 and I lent, let's just say 200, I got $100,000 of value. So I very much doubt the markets are going to capitulate enough to take away my 100 grand. So I think I'm in a good place. So that's what I would say about private lending. So James, I think this is a great strategy. It's a great strategy from an income play, okay? Because you're going to get paid income, plus you're protected and collateralized. Stocks are not protected and collateralized. The treasury bonds that I mentioned are guaranteed by the full faith and credit of the United States government. So that's probably a little better than the real estate. But the last time I checked, real estate's probably one of the safer things to get into because there's an asset that backs the investment or the loan in this case. Any questions on that, anyone? I love Don's question. Don said, is there a penalty if you sell the treasury bonds before the 30-year term? No, nope, not at all. If you bought them direct from treasurydirect.gov, there might be a hold period. They might make you hold them for 12 months. I don't really know. I haven't bought any long-term treasuries on treasurydirect.gov, but I have bought TIPS, which are back when inflation was going nuts. I bought treasury inflation protected bonds, which I still own, but that's all I bought on there. So there could be like a couple year hold. And if you sell them early, maybe they keep a little interest, but it wouldn't matter. Like if your interest is, what did I say, 4.2% or something like that on the treasury bond, and you got to give back 6 months of that 4.2% interest, but your price of the treasury bond went up 38%. I mean, I'll take the 38 and give back the 2% of interest that they didn't pay me or that. But yeah, I don't know, Don, you'd have to just go on treasurydirect.gov and check it out. Okay. Any more questions on private lending? What's a good ballpark? That's a good question. So Anonymous said, what's a good ballpark rate on home equity lines of credit? So here's the advice I'd give you. And I'm going to be talking a lot more about this. So right now, because the Fed is dropping interest rates, banks are coming down and doing lots of teaser rates. So I'll give you an example with the policies, especially designed and engineered policies that we're going to get into next, because the next 30 minutes is just going to be about the infinite banking concept. But the policies right now, the loan interest rate for the insurance companies is anywhere between 5.2 and there's one that's 7% now. So I know now we can go to a bank, we can put up our policy as a collateral, and the bank will give us rates. I just got a teaser rate the other day from a bank called Coastal States Bank. And what was it, Stephen? 5.35? And it depends on the amount of cash value you have, but I think the best rate was like 5.35. With an 18-month lockup. So they want you to keep the line of credit for 18 months. Is that what it was?
Yeah. For the cash value line of credit?
Yeah.
Greater than $500,000, 5.85 for 12 months with an 18-month early termination.
5.85. I can't remember all these numbers in my head. But so the reason I mentioned cash value lines of credit is the same thing is happening with home equity lines of credit. The home equity lines of credit, we were seeing rates of like 9+%. You'll still see rates of 9+%. But what banks are doing right now, because they know interest rates are coming down, and you have to have a variable rate home equity line of credit for this to happen. I want to preface that, is banks are giving like 12-month intro rates. I know this because I literally just did this. I found a credit union here locally that had a 3.99% intro rate on their home equity line of credit. So I gobbled that up. I got like, I can't remember how much I got, $600 and some thousand on a home equity line of credit at 3.99%. So now imagine that, 3.99 for 12 months. Let's say I took that money, which I'm lending on a deal right now. I take that money, I lend on a deal at 12%. So I make 12 minus 3.99, and my deal I would only do for the duration I have left on the intro rate. I'm doing pretty good there. So that's what you're doing. So with home equity lines of credit, just go out there and shop the market, because there's all sorts of teaser rates for 12 months right now, maybe even longer. I just know that's what I found. And you're going to see that. You're going to see rates coming down more and more. Any questions on this? Let's move on. All right, so the next thing I want to do is I want to just I want to give you a really simple way. A lot of people ask us, well, how much would my money grow if it grew at this percent or that percent? Well, as a financial advisor, when I was one, we always use this thing called the rule of 72. Okay, who on here has heard of the rule of 72? Put I in the chat. And can anyone tell me what the rule of 72 is? It's super simple. Anyone? Andy just said some credit unions are doing teaser rates for 1.99. Yeah, there you go. Cornerstone. That's correct, William. There you go. So Anthony's doing the math. It's very simple. All it is basically if your money earned 7.2%, there's a mathematical calculation, but I'm just going to give you the simple way. If your money were to earn 7.2%, it would double every 10 years. And then you could just reverse it. If your money made 10% interest, it would double. So I'm just going to write double every 7.2 years. But I did some more math for you just to kind of show it. If your money were to make 12%, like I showed you with private lending, your money would double every 6 years. Okay, if your money made 6%, pretty crappy 6. If your money made 6%, it would double every 12 years. And if your money made 3% in like a high yield savings, it would only take you 24 years for your money to double.
I know.
There you go. Simple. And you can go online and you can look at the math behind it. You can do any calculation with this. It's called the rule of 72, but that's just the simplest way to do it. Just do the 7.2 and the 10%, and I think you can get where you need to be. So here's the thing. Everything we've talked about now is about preserving and protecting wealth. Well, there's one thing we haven't talked about, which is what we really stand for. It's what all my stuff I'm wearing right now, BYOB, I can't remember what this one says, so hot right now, which it kind of is, in the hat. It's all about taking back control. Now, the one thing I haven't addressed is most of you are not in control of your money, because most of you have your money sitting in someone else's bank. Bank of America, Wells Fargo, Citi, whatever bank you have, whatever the name is, your money is sitting in the bank. And I already told you how the bank makes money. You put your money into the bank then lends your money back out at a higher percentage. Okay, that's how the bank works. So in order for you to take control of that money and not have that happen, what we need to do is we need to change one thing. And that is where that money, and when I refer to this money in the bank, I don't mean the money you pay your groceries. I don't mean the money you're buying milk for your little one. I'm talking about just savings, just the money you save. So I want to be very clear about this, because I think a lot of people in the infinite banking space do an absolutely terrible job of explaining this. We're not talking about moving all of your money into this vehicle. We're talking about just the money you save. So example, some people have a Christmas account, right? Like you got the Christmas account. How many of you have a Christmas account that you save money in? How many of you have a bank account that you save money, like a college fund? Okay. How many of you have just an emergency fund? Some people call it a bus fund. Emergency, fit it. Okay. All of these are like maybe it's a 529, maybe it's just a bank account, maybe it's a high yield savings, maybe it's a money market, maybe it's a brokerage account, but all of you have them, right? Or most of you know people have them, right? Okay, so we're talking about this money, your Christmas club money, your money you're saving for your kids' college, your emergency money. Now, I'm gonna kind of put a little asterisk, because there's a couple things I want to talk about with the emergency fund. It's your money you're saving, and hell, it could actually be money that you plan to invest. So this is your savings account, and that's money that you plan to invest. All we're going to do is change where that money goes first. And we're going to put it into a specially designed and engineered whole life insurance policy from a mutually owned life insurance company. Now, when I say that, a lot of people right there, they're like, why would I do that? Okay, well, I'm glad you asked. So I'm just going to show you, and I'm not going to spend a ton of time doing this, but I'm going to show you with just a made up example, and then I'm going to show you with my policy. But here we go. Now, I'm going to do two different things. I'm going to do a big policy and a relatively small policy. This, as you know, is the big policy. So why would we take our savings and put it into a whole life instead of putting it into a bank account or a brokerage account? And why the hell would I take my money from my savings, put it in the whole life versus investing that money in treasury bonds? Okay. I did a whole YouTube video on that, just so you know. It's called The Perfect Investment Strategy. So let's just say somebody had $1 million. It's just a number that's easy to do math on. They had $1 million. And they were like, hey, I want to do something with this $1 million. Okay, great. What do you want to do, Mr. Client or Mr. Smarty Pants? I'm just making names up here. What do you want to do with that money? Well, I don't know. I want that money to grow, and I'm saving up to buy an investment property. Perfect. Well, let's change where that $1 million goes. And then let's save up for a couple of years and let's buy something. So here we go. We put $1 million in. That $1 million, and this is for a 46-year-old, okay? And change a little if you got a little older, but right here, you would have roughly out of the $1 million, you'd have 917,570 to use right away. Whoops, there, it's the same number. Okay, so some of you would be like, well, that's stupid. Why in the world would I ever do that? Why would I take $1 million, put it in something that now I only have 917,000? Well, I'll tell you why. Because I don't know many people that have $1 million that put it in the bank and then immediately go back in the first year, 2 years and take the $1 million out. They usually put $1 million in, they use what they need, and then it grows, right? So if you needed the full $1 million, then this wouldn't work. So that's easy, right? So we could just discount that question and just don't do this. But if you didn't need all the money, you now have 917,000, which I think by the math is about 92%. So now here's the reason why. If I needed this 900, let's just say I found a property, okay, 30 days after I put the money in here, and I needed 900,000 bucks. Great. You can then go into your policy, which we're going to deem and call your private bank. Your policy, this policy that we just put $1 million in, is now the start of capitalizing your private bank. You have to think as if you're a bank. So now we got a property. We're going to buy for $1 million. There it is. Okay. Or sorry, for 900 grand. So we take 900 grand out. How much money's left in your account? You started with 917, you took 900 out. How much is left? Well, most of you would be like 17,570, but not in this account. See, in this account, you'd have $917,570, even though you took 900 and you bought a property. But that doesn't make sense. That sounds too good to be true, but it really doesn't, because the life insurance company promised, when you did this $1 million deposit into this life insurance contract, they promised that if you died anytime, okay, up to age 121, they would pay this death benefit of $13,525,470. That's the promise they make you in the contract. But you got to die to get that. So what the insurance companies allow in these specially designed and engineered policies, not all life insurance works this way, and definitely, please understand this is not a normal whole life. We build them to do this. There's no way you could go to your broke-ass brother-in-law and say, hey, saw this guy Chris talking about this whole life thing. I know you sell these stupid things, but can you do me a policy? I want to put $1 million in. He'll come back to you with a policy, probably not even a whole life, and it will have no cash value in the first year, probably none in the second year, and probably hardly any in the third year. And you'd be like, oh, that Chris guy, I knew he was full of shit. No, your broke-ass brother-in-law doesn't know what the hell he's doing, because in order to make it work this way, what we had to do is give up almost 90% of our commission. So then now try doing this. Go to your broke-ass brother and be like, hey, I need one of those life insurance policies. I want to put this money in for this infinite banking thingamajigger. And by the way, broke-ass brother-in-law, I need you to take a 90% cut in your commission. Yeah, I know you need new tires on the car, and I know the roof's falling in on your house. You're broke. I get it. Like, but that's what I need you to do. Yeah, they're not going to want to do that. Hell, they're going to tell you that's not possible. But to do what I just showed you, indeed, what happened is we literally had to take a giant percentage cut in our commission. I don't know if it was 80 or 90% in this one. But here, the 900,000 we took out, how is it possible that you still have 917,570 earning interest and dividends? And in this policy, I think this company would be about, I don't know where they're at now because they just had a dividend increase, but let's just go with the old number, 565. I think it's a little higher than that. You were at 500 or 5.65% on the million. That's your gross return, or what they call the dividend crediting rate. So the 900 you took wasn't your money. You see, what the insurance company does is they give you a loan. Okay, they loan you 900,000. Now hold on, don't poo-poo on this because you're like, oh, I knew there was a catch. It's a loan. It's a loan against your death benefit. So they took 900,000 from this 13 million. Hey, dude, you already told me you didn't care about the death benefit, although you will someday, your family will, but you don't care about it. So what does it matter if we take 900,000 from the death benefit? You said you don't care about the death benefit. That's what you're doing. The insurance company is loaning you $900,000 from the death benefit. They're charging you interest on that loan. And right now, the companies we work with are 5.2 to, I think the highest one we have is 7. So clearly, if you're in that 7% one, we're going to probably use a cash value line of credit because I just showed you that cash value line of credit. But now we got the ability to use $900,000 at an interest rate lower than the interest rate we're earning over here. Everybody got that? That makes sense, right? So the next year, the money grows, and now you put 100,000 in, you now have 1,024,000. So how we normally would do this, we would just do the math, but the company does it. I put 100 in, and I can use 107,219. Whether or not this 900 was in the policy or not in the policy, it's called non-direct recognition. The insurance company doesn't recognize the loan. So they pay you this, or whatever the interest rate is for this company, they pay you that on the full amount, okay, on the full cash value, regardless of whether the cash value is in the policy or not, because the insurance company didn't use your money. They just collateralized this death benefit loan with your money. Holy cow. What does that sound like? The bank? Doesn't that sound like what banks do? Yeah. You now have a bank. This works just like a bank because now what did you do? You just made a spread. You just made a spread on your money. Now hold on, it gets even better. Next year, you put another 100 grand in. You save 100 grand, and now we can take 107 out. So if I put 100 in and I get 107,219 back, in 12 months, what's my return on the money? I think all of you can figure that out. 7.2%. Isn't that kind of funny? The law of 70, or the rule of 72 said if I did that every year, my money would double in 10 years. Okay, great. So I made 7.2%. So what is 7.2 minus 5.2 or whatever number? It doesn't matter. It's more. Okay? You made a spread and your money got to grow uninterrupted. You made compound interest on all of the money that you put in. It's growing, compounding, and you get to use the money and make a spread. But it gets better because every year you do this. Next year you put 100 in. Now you got 13,000 extra above the 100. So because listen, what does this say? This is the insurance company's illustration. Increase in net cash value, 113. Hold on a second. I put 100 in, $102, and I got 113 out. Well, damn, man, that's like a 13% return. No, that is a 13% cash on cash return. So, but you know what? If we wanted to use that 113, we got to pay the piper. The insurance company is going to charge us, let's just say 6%. So what is 13 minus 6? Does it matter? It's more. You made a spread. And then whatever you take that 113 and invest it in, that money makes money a second time. You have literally just found a way by changing where the money goes first to make money twice on the same dollar. So now, does anyone have any questions as to why we use this stupid whole life insurance? Good. So we put the money in the whole life. We take a loan from the insurance company, okay? I'm just going to draw this. This is your bank account. So we put the money in your bank account first, because I always got to show it stopping off at the bank. And then we buy that house, $900K. I'm just going to use that example. Now we own the house. Let's call it an Airbnb. And then we rent the house. So we rent the house. I don't know, let's just say $900,000 house got rent for what, $5,000 a month? So we rent the house for $5,000 a month. We take this $5,000 a month in rent. Where are we going to put that? You're going to put it back in the bank, right? Here's your bank. So now every month, $5,000 is being deposited in the bank. But do we want to leave our $5,000 in their bank? Or should we put that $5,000 back in our private bank? Wouldn't you want that money going to your private bank? Why leave it in their bank? So what we're going to do is we're going to then take it from their bank, and every month we're going to move it back into your bank, $5,000. How much money do you have when you do that? $5,000. Every month you put $5,000 in. What it does is it reduces the loan. So every month we're subtracting, in this example, and I'm just netting, I'm not netting it out. I'm just saying you bought a $900,000 property, you make $5,000 net every month, and you take that money, you put that money back into the policy. Well, when you do that, you are reducing the loan, which means the insurance company, if they charge you 5.2%, they're only charging you 5.2 on $5,000 less. Every month you put money back in the policy, you're paying the loan down. What happens with your home equity line of credit when you pay it down? Isn't the amount you owe the next month less? Yeah, because the interest is calculated on the remaining balance, not the total balance. So you're declining that. You're paying interest on a lower declining balance every month, and all you're doing is just being a bank. You're moving your money from your bank to investments, then from the investments back to your bank. Round and round we go. It's like Monopoly. except for you don't pass go, you just turn a new year. And when you turn a new year, the insurance company pays you a dividend. And by the way, the dividend in that policy I just showed you, this is your monopoly money, is right here. So first year, you put $1 million in. When you pass go, which is 12 months, 12 months goes by, the insurance company puts in $34,675. Next year is more. The year after that's more. Everybody see that? Every year is more than it was the last year. How about this? Your cash value, is it more or less every single year? More. Can't do anything other than that because it's got a guaranteed interest rate on it. Does the stock market work that way? Nope. Does real estate always work that way? Nope. This does. So you want to keep your money in the bank, the traditional bank, where I can guarantee you the interest you're earning on your bank account, your high yield savings account, your CD or your money market is going down. Guaranteed. The money that's in your policy does not change. The guaranteed interest rate does not change. It's contractually locked in. All right. So now we did that. So everybody understands that. The infinite banking concept is not the policy. It's this process. To be a bank, it's not just changing where your money goes. To be a bank, you got to do what a bank does. You got to keep money moving. And if it's not a property, it's a car. If it's not a car, it's a jet. If it's not a jet, it's a washer and dryer that you were going to finance, or a refrigerator that you were going to finance, or a dishwasher you're going to finance. Listen, I could keep going on and on and on. Maybe it's a business that you wanted to open up that you start, that you don't have to borrow money from the bank because you are the bank. And every one of these things, guess what? If you borrowed it from the bank, it would have a payment that you would have to pay to somebody else. And you're still going to make the payment, but you're going to make the payment back to yourself every single time. And you lose no liquidity because whatever the payment was that you're making on the car, the house, the fridge, is all money going back into your bank. You get access to 100%. What do you lose? The interest paid to the insurance company. But does it matter what the interest is? Does it matter what you're paying to the insurance company? It does. But the only thing that matters is that your policy is making more than what you're paying to the insurance company. That's it. What questions do we have on that?
So what's wrong with moving all of your money into a policy, not just Christmas club money?
Well, Andy, the reason I don't suggest that, there are a lot of people that say that. Even in Nelson Nash's book, he says the goal is to get all your income into the policy. But the problem is, I'll just give you an example. Let's say you moved all of your money. You just got rid of savings and you moved all your money. And then all of a sudden you had to pay for things like groceries. Okay, I'm just going to draw a grocery bag, and you got all the stuff. When you buy groceries, what do you do with the groceries? You eat them. Do they make you any money? Can you charge like interest to your groceries? Can you go buy bread and then bring the bread home, put it in the fridge, and then charge the bread interest? It's a zero-sum game. You're going to eat the bread. You need it to live, but there's no equitable benefit for that. So we don't want to put money into the policy that we're going to use on basic expenses that don't earn us something. We want to put money into the policy that we can move out where it's going to be able to earn an interest rate or a return that is higher than the cost of capital. If your cost of capital from the insurance company is 5.2, our goal is wherever that money from your policy goes, it just has to make more than 5.2. That's my rule. That's not that's not an IBC rule. That's just a Chris Naugle rule because it just makes sense. And sometimes I don't like making things complicated. So I know that 6% is more than 5.2. So as long as I move my money out into something like 6% or lend that money to myself for a car at 6%, I'm making money. And by the way, I'm not just making money, I'm keeping all my money. That's it. Good question, though.
All right. Someone with a lung disease, 36 female, lung disease from the military, can't get insured. So what other options would they have? Would you recommend?
Yeah, that's a tough one. Lung disease is definitely an automatic denial. So what you'd want to probably do is find somebody that you have an insurable interest on. Could be like a spouse, significant other, a child, a parent. Could even be somebody that works for your company that's an executive, somebody you have an insurable interest. They become the insured and you become the owner. Because listen, everything here, the only thing, actually, let me show it up here. So if you did that, sorry, I'm using this big example. It's right here in front of me. If you did that, you just would not have the death benefit on your life. This would be on someone else, okay? But you would control all of the cash value, which is really all we talked about. And then if should anything ever happen to the person that you basically took the policy out on, I don't know what I just did, but if anything ever happened, you could become the beneficiary on the policy. So you could be the owner and the beneficiary. So if the person you put the policy on passed away, you would be the recipient of the death benefit. So that's how you do it. There's really no other way around it. It's not like you can go to the insurance company and say, hey, this one denied me. Can you insure me? It's rare that that would happen.
Right. Don said, I'd love for you to do a video on the taxes paid on a real estate interest made on deals and the interest cost on the policy loan. Is the spread still worth it?
Yeah, I mean, we've done similar things, but Don, I could do that video with, maybe Jimmy would do that with me because I would need a CPA. I can't give tax advice. That's the only reason I don't do a lot of stuff on taxes. But if I could get a CPA like Jimmy or Mark or somebody else to do that video with me, I could, because they could talk on the taxes, or maybe Zach Newberry would do it. They can talk on the taxes and I can talk on the policy, and we can make that work. So Don, let me see if I can't make that happen for you.
Let's see. Andy said, why use non-direct recognition companies? A few years ago, Snaggy played around with Guardian. And we still have Guardian. How is that going? Is loan crediting math not working as well?
Shoot, man, that's Andy, that's a great question. Matter of fact, I just did the math on that. It's sitting on my desk in my office. I have a non-direct recognition, or I'm sorry, a direct recognition company. Actually, it's Guardian. And I own a Guardian policy too, but I have one of those on my desk, and I've got the original illustration that we did for the client. I think it's 5 years old now. And we have another illustration, which is called an in-force illustration, that he has had this policy and he's had continuous loans on it. I think he's got like $50,000 or $60,000 in loans. And if I compare the original illustration's cash value to the existing in-force illustration with loans, you will see it's not a huge difference, but there is a slight decrease in the cash value on the in-force illustration versus the original. The impact, the only reason that is the direct recognition company pays a lower dividend because they recognize the loan and they adjust the dividend down, because now if you had 100 grand and you took 50 out, they're going to pay a dividend on roughly 50 grand, like the remaining amount. So your cash value is less. I do plan on doing a video on that. I apologize, I'm traveling literally nonstop every single week through November. So videos, I'm just doing stuff that I've got prepared. So I will get that ready for you, Andy. We'll actually, I'll do even one better for you because you asked. I'll do a YouTube video and we'll do a wealth webinar all about it, and I can show the math. I just got to go through that illustration, block off his name, and I show it. And then I could literally show you mine, which right here, this is one of my policies. This is a Mass Mutual policy that I started, I think it's 4 years old. Yeah, 4 years old. Literally just turned 4 October 1st. This is a direct recognition company. I've taken loans out on this policy, and my cash value within a couple of dollars is exactly the same. So that would be a good video to do.
Yeah, I mean, and Andy, we're always going to lean towards the non-direct recognition companies. It's all about the uninterrupted compounding returns, but there's certain situations, depending on where somebody lives, depending on their health conditions, their age, there's a couple other factors where Guardian is a strong play and a strong company to use. It works great for this concept, even though they are direct recognition. So it's something we take into account on every single policy and every client that we have. And one of the nice things working with us, and we've been doing this for so long, we've seen it over the years, what's supposed to happen, what actually happens. Like Chris said, he has, 5-year-old policies where we can actually run the numbers. And so it gives us a lot of real world experience to be able to guide clients in the right direction. And just to kind of point that out, if you guys are new here, this is what we do. So we do design these policies, we strategize with you. I'll put the link in. So if you're new to this and you're like, hey, I'd like to start one of these policies, or maybe have a strategy call, what would this look like for me and my goals, whether you're paying off debt, whether you're just investing and growing wealth, I'll put the link over in the chat box so you can schedule a call with one of our money mentors. Sheila said, Chris, if you buy treasuries, what would happen if we are put on a digital currency, let's say 6 months from now?
Nothing. I mean, they're U.S. government bonds. So if we went to digital currency, they would just pay you interest in digital currency. And that's it. I mean, a lot of people keep asking me about this digital currency thing, but really, like, the effect of the digital currency will be nothing different than what you're used to today. How do you pay for goods and services right now? The majority of you on here are paying for goods and services using a credit card, a debit card, maybe Apple Pay or one of those tap pay things, which are just freaky to me. Or you're paying, with Venmo, or you're paying with a wire or an ACH, all of which are essentially digital currency. You are not holding physical cash anymore. You're doing most everything with digital currency now. So the effect of digital currency on treasury bonds would be nothing. It would be business as usual. You would just receive whatever payment in interest they pay you. And when you get your principal back, it would be in digital currency in your wallet. I don't know. I don't know what that's all going to look like, but it'll be business as usual. The only downside with digital currency is they'll be able to track and control everything, but I don't know. I'm not going to lose sleep over that. Plenty of other things like missiles flying into Israel from Iran to worry about that are far more pressing than worrying about digital currency and how that affects my treasury bonds.
True that. Regarding moving all money to a policy, why not use the policy as early retirement strategy and just ask for loans to yourself to survive on? I guess this is for when the policy is mature enough.
Oh, 100%. Matter of fact, I have a whole YouTube video on that. So go to my YouTube channel at the Chris Naugle, type in retirement or supplemental retirement. I think I've done like 3 or 4 videos on how to do exactly what you're saying. So yeah, that makes all the sense in the world. Then you're funding, essentially you're funding a bucket of money you're going to use for retirement. You might not take loans though. Here's where the strategy gets a little different. In a retirement strategy where you're using it for general income, like retirement income, you would take withdrawals from the policy up to the cost basis and then go to loans to not have to pay taxes. So it's just a slightly different strategy because it's for a different use. But when you take withdrawals, just know you're depleting the cash value. So you are depleting the amount that you're earning interest on. You could just take loans, but we've run the math, and it typically in a strategy like that where you've matured the policy, you funded it, and now you're retiring, it's better to take the withdrawals, at least by the math we've run so far.
Perfect. Rick said, my wife and I have each individual AUL policies in place. How do we know when we should open up additional policies?
So how I do that, if I can, this is from Rick. Okay, so in this example, let's just say I'm funding my policy with $30,000 a year. I'm just making numbers up. Okay, so every year, the amount that I'm saving is $30,000 into the policy. So each year, I can put, for at least the first 8 to 10 years, I can fund it at $30,000. But let's just say every year I lend that money out and I do all these different things, and all this results in $10,000 coming back. So now I'm taking this 10 grand and I'm putting it into the policy. But if I had velocity of 10 grand going into the policy and I'm taking loans, pretty soon my loans are all repaid and I want to put more in. I can't. So now what happens is your bank account starts filling back up with cash because you've got all this money that you're recapturing in, and all of a sudden all this 10 grand that you used to be putting into the policy that you can't anymore because you mech it is filling up here. I do this all the time. I just opened another policy, a $2,000 a month policy. Okay, I'm not done with it yet. I just started, literally signed the application 2 days ago. And I can speak on a real example. So how this happened is, what I do is my cars, I rent my cars out, okay, well, at least 2 of them for $1,000, I don't know, whatever. It works out to be like $2,500 a month. So that $2,500 a month is income to one of my other companies. So one company rents them to another company. I'm not going to get too deep into that because it's just a whole nother topic and probably a whole nother YouTube video. But I rent my cars out for $2,500 a month. That $2,500 comes over here, but the policy that I took that money from already has, I think, like 11G going into it in recaptures. I just can't fit the 2,500. So that 2,500 just builds up in a bank account every month, a business bank account. So what I did is I said, hey, Melissa, what we're going to do is we're going to set up a policy. And what we're going to do is we're going to use this $2,500 to fund the policy. And actually, the $2,500 pays for the insurance on the cars, which is $300, but roughly about $2,000 a month makes it back into the policy. And then now I got a new policy, but it didn't cost me more. I didn't have to worry about my income. It was just money I created because I had an asset that I rented out. And that asset created an income stream that I didn't have before. And I want that income stream to go into my banking system. So that's how you know when to do another one. It's when either the velocity of the money going round and round is just building up in a bank, or your income increases and you want to save more, or you do something where you buy an asset that creates more income and you want that income to go into the policy. And I'm sure there's more ways to do that, but that's the quick synopsis.
Yeah, Deborah, this call is usually 90 minutes, but we usually go a little bit longer. David said, Chris, what's your opinion? What's better off, taking a home equity loan or a home equity line of credit for their property?
Depends on the math. A lot of them right now are making more sense to do the home equity loan, as long as you're working with a bank, like Joe talks about this all the time, and Craig too. If you're working with a bank that can kind of facilitate the velocity banking, like they can associate a bank account with the home equity loan, usually that will make more sense. But I would say get with Joe on our team because he's really good at that stuff. I'm not an expert in that to know which one is better or not. For me, everything's just math. If I can solve it math-wise, then that's the one I go with. I didn't do a home equity loan because I didn't want to pay closing costs, so I did a home equity line. And plus, I'm trying to pay my house off, so I don't want a home equity loan. I just, either way, it would have worked the same. I just didn't want to pay closing costs. Call me cheap.
Let's see. Eddie just came in. I heard somewhere that creating new policies becomes more difficult after your total death benefit exceeds 10 million. Does that sound right?
Depends. For one person, that might be, their max 10 million. For another person, they're just getting started at 10 million. It comes down to what's called your human life value. So the insurance company, based on your income. So when you do an application for one of these policies, they'll ask you a bunch of questions like, what is your income, your gross income? What are your assets? And they'll break down some of the assets for bigger policies. They'll ask these questions, and then that number will determine a human life value. And every time you do a new policy, you do a new one of these. So as you make more and accumulate more, your human life value goes up. So I don't know what your human life value is. There's a calculation that we can do. We can go to the insurance company's website and we can run your human life value calculation based on your income and assets. And that's how that works. So it's not like a definitive number like 10 million and you can't get any more. It's all based on what you make and what you have. So again, we're going to put that link up for the Money Tank, which is again November 8th and 9th out in Charlotte, North Carolina. 20% of your admission to that event will go to a charity that will benefit and help only those that were affected in the hurricane. Okay, that's what this one is, very specific. Secondarily, if you did the VIP, which I think there's a couple more VIP tickets, you get to do an exclusive event that I'm going to be at. So I'm not going to, the other thing that we're doing with this event is some of the folks, like the VIP folks, are going to have more access to me, and I'm going to make myself available for VIP. I'll be there, and I'll be talking to people, but you really won't have direct access to me unless you're VIP. And I'm doing that just because when I go to these events, it's gotten very difficult for me to really focus on people's problems because everybody's coming up to me. So now we've made it so that, if you're VIP, you get to really hang with me, talk with me, and I'm going to be able to kind of dive into your circumstances a little bit more. General admission's still great. You'll still see me and everything. I might not be as available to you.
And there are a couple of tickets left for Nashville next week as well. Just email Jamie. I'll put the email in there. And then, of course, the last minute offer in Phoenix, Arizona this weekend. If anybody's looking to join Chris in Phoenix, he'll be at the RAL, which is a residential assisted living national conference they do each year down in Phoenix. It's always a great event. And Chris will be sharing the stage as keynote speaker with Ed Milet. And then they also have Kim Kiyosaki speaking, as well as Mark Victor Hansen and a whole another lineup of a bunch of more people. So it's gonna be a pretty cool event in Phoenix as well.
Yep. Lots of events. So you can see me in Phoenix. You can see me in Nashville for the Money Multiplier Mastermind, or you can see me out there in Money Tank. And that one to me, I think is the best one, simply because we're going to be doing all sorts of events, like all sorts of activities, kind of like experiential stuff. It'll be wild. Plus it's at a racetrack, and
you got Orlando mixed in there too, but we'll save that for later.
Oh yeah. Then Christy Van. So if any of you are, going to the Christy Van Fantastic event, I'll be there speaking as well. And then if any of you are going to be at Shonda Sumter's event out in Puerto Rico, I'll see you there too. And if any of you are going to be at the OREA event out in Ohio, I'll see you there too.
Here we go. Travel season, election season, war season, port strike season. We got a lot going on right now in this world. That's the beautiful thing, though, is it's so crazy right now. Like everything we do with these whole life policies, it's just zen. It's peace. It's clarity in times of calamity. And that's why I love this, because I know that my money's sitting in these forget what the banks are doing. Banks are disaster. Federal Reserve, it's all a mess right now. But the money in those policies is sitting, chilling. These companies have been around for over 200 years. And it's nice and secure, nice, steady, strong growth. And we'll take on some risk when these opportunities start to open up as the economy starts to turn. So that's what it's all about, man.
Well, Stephen, we always say the scarier it is out there, the safer it is in here. And what we're referring to is in our community, because we're really looking out for our folks in our community. We're trying to keep you guided on the proper things, sometimes a little forceful in terms of like slapping you around and, getting you the visuals of getting punched, or, well, for men anyway, getting punched or kicked in the balls. We're trying to let you know what this whole thing could feel like if you don't take some action. But the other thing that's really cool about, the money tank is, it's a nationwide network. So when these things get rough, you're going to have access to people. You're going to need lifelines, like especially real estate investors or other investors. Like you're going to need lifelines. And if you don't have that nationwide access, that network, then it's going to get tough. Because I'm going to tell you this right now, you're already seeing it. Banks they're shoring up their balance sheets. They're starting to lend less. They're slow on closings. Hard money lenders, although right now are still lending pretty regularly, but I guarantee you when things kind of tighten up, they'll tighten up. They did it before. I remember that in 08. I remember that during COVID. All the hard money lenders crawled into their little caves and held their money and didn't do anything, and then came back out and be like, hey, sorry guys, we took a vacation, but anyone need any money? And that's how they always work. But private lenders are the steady Eddie, the backbone, the community you need, and that'll be your lifeline.
Yeah, man. Last question on a direct interest for using someone else's body. How far down the family tree can it go? Grands, kids, nieces, nephews. William, just connect with us, because depending on what the situation is, we can definitely make that work. Grandkids, we do all the time. Nieces, nephews, we might have to get the direct parent involved. Sometimes we don't have to. So just connect with us and we can, we'll figure out exactly what that looks like for you. And I'll put one more time where to schedule a call over in the chat box.
Cool. Cool. All right, folks. Well, that's a wrap for another episode of Wealth Webinar. Hopefully you enjoyed that. Hopefully some of you got a laugh out of that. Hopefully I didn't offend anybody, but even if I did, that's good. I sometimes have a tendency to do that. But with that being said, folks, the truth hurts. Get used to it, but you'd rather the truth than not being told what's real. So we'll see you on the next time. Get going with taking back control of your money and become your own bank. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.